thanks for joining us. My name's Tom Wheelwright. Most of you know me. The author of Tax-Free Wealth and the Win-Win Wealth Strategy. And I have with me a very honored guest who's been on my podcast several times, Garrett Watson from the Tax Foundation. Garrett, welcome to our town hall.
Thanks for having me. Really excited to discuss with you and everyone on the call tonight.
Thank you. Hey, so would you start just by explaining a little bit about what the Tax Foundation is and does?
For sure. So the Tax Foundation is a public policy research organization, commonly known as a think tank. We're based out of Washington, D.C., and we focus on education and research related to tax at the federal, state, and global levels. So we really focus on tax across the board. We're actually one of the oldest think tanks in the country. We were founded in 1937, and our focus has really been on better education for both taxpayers and policymakers with the aim of improving the tax code. And we really stand for things I think everyone can get on board with in terms of simplicity and efficiency in the tax system. And of course, our job is never done, as you can see with a lot of this legislation we're going to be talking about tonight.
Yeah, thank you. And the Tax Foundation, which is taxfoundation.org, right?
That's right. You can find our stuff at taxfoundation.org. We're also on Twitter at Tax Foundation.
Awesome. And Tax Foundation is just a wealth of information. They do a lot of analysis and they do a lot of statistics. And so I do draw on Garrett on a regular basis here. I think I know something, and then I find out that there's so much more that I don't know. So it's that's the great thing about the tax business, is the more you know, the more you realize you don't know. So I don't know everything. I'll be clear here. And hopefully between the two of us, we can answer your questions and really solve some of the questions you've got about this new bill. What we want to do is we're going to spend about 40 to 45 minutes, just kind of discussing the bill. And then what we'll do is we'll open it up for questions. So I'm just going to give it, our best shot here. I want to kind of focus on some of the key provisions. There's a lot of stuff in here, most of which isn't going to apply to most of you. For example, the Medicare drug prescription part of it, unless you're on Medicare, not directly going to affect you. Now, it may affect drug prices otherwise, but it won't directly affect you. So that's one where we probably won't spend a lot of time. There is an extension of the Obamacare credits. And Garrett, if we get time, maybe you can, if I can rely on you to talk about that a little bit. But really all it's doing is saying, well, instead of that expiring, it's going to continue for the next few years. So that's basically all that is. So nothing really changes there except for the expiration date. There are a few tax provisions that are not well known to people, and I do want to go over those that are not so well known, particularly the business loss limitation, Garrett, because I think that's actually a pretty big one for people, and I think a lot of people just not aware of it. We'll of course talk about the IRS and their new funding and what to expect or hope from that. Expectations and hope would be two completely different things, but what to prepare for. And we also want to talk about, okay, so what are some of the opportunities here? Because there are some major opportunities in this bill. What the first thing I noticed, Garrett, is, this is a really good example of how administrations, whether an administration uses the tax law for incentives does not seem to change from administration to administration. All that seems to change are the incentives that they provide. And incentives, sometimes they take away incentives. For example, 2017, there was a big decrease in the deduction for state and local taxes. Well, that was an incentive for state and local governments to charge more tax, frankly. And so that incentive was taken away, and other incentives were taken away. Your miscellaneous itemized deductions went away, and but other incentives came up, like the bonus depreciation on real estate. So that's the way the tax law works. The tax law is really a series of incentives. It's very heavily skewed towards business owners and professional investors to do things that the government wants done. And this bill is a really good example of that. As this bill illustrates, what the government, we've all heard of the Green New Deal and President Biden saying, first and foremost, I'm a union guy, and those are both in this bill. Okay. And they're both very heavily in this bill. So that should not be a surprise to people. But these are really what we're doing is we're doing things the government wants done. And if we do things the government wants done, then as I explained in the win-win wealth strategy, the government gives us tax benefits. What this bill does is extend some of those tax credits and makes them bigger. It actually makes them retroactively bigger, which we'll get to that. And then it imposes requirements such as paying union prevailing wages in certain cases in order to get the maximum credit. So what I'd like to do, Garrett, if it's okay with you, is I'd kind of like to just walk through some of the basic provisions before we actually get to any of the planning or things that we can do here. And maybe if you can just kind of help me along with this, but if we could, let's start with, there's really just two primary individual non-tax credit issues. One is of course, the ACA health insurance premium tax credits. Garrett, that is extended through when, 2025?
That's right. Yep. So the extended provisions there for the health credits, of course, were originally in the 2021 American Rescue Plan Act, and they've pushed it through 2025. That mostly covers folks who were sort of between the poverty line and 400% of the poverty line who didn't have access to those subsidies. There's sort of a hole there, and they were trying to cover some of that with these extended subsidies. So that'll be going through 25, and they'll have to decide what they want to do after that.
Exactly. Perfect. And the second one is the business loss limitation rules. Now, here's what we have now in the tax law. We have a whole series of limitations on the losses that somebody can take from investing in a business. And that business could be real estate. It could be your own business. It's not a stock. Okay. We're not talking about stocks, because stocks, remember that the tax stays at the corporate level with your publicly traded companies. But I'm talking about a small business, something that is taxed as a partnership or an S corporation that flows through, or a sole proprietorship that flows through to the individual owners. Okay, that's the type of business we're talking about. Now, what we have is, a lot of times business starts up and it has losses. Or real estate, we have these massive tax deductions for bonus depreciation right now, which start to phase down next year. We should probably also talk about that. But those losses have several limitations on them. For example, if you don't have one, it's called basis. If you don't have basis, that's your cost, yours plus the bank's cost. You may not be able to take the deduction. One is at risk. If you're not at risk for your money, you may not be able to take it. One is the passive loss rules. If you, if the losses are passive to you, you may not be able to take them. But since this beginning in 2021, we have a new one called the excess business loss limitation. And what this says is that losses from all of your business activities, including rental real estate, can offset any other income from other business activities. Okay, so if all of your income comes from business activities, you can literally get your taxable income down to zero. However, what if you have wages? What if you have dividends? What if you have interest? What if you have retirement income? Those are all considered non-business income for this purpose. What happens there is you can offset your business income, but over that, you can only offset up to $500,000 of other income. And of course, if you don't have $500,000 of other income, you're not concerned about this, right? But there are some of you, I know that some of you on this call are over that $500,000 limit. What I want to mention here is this means that having you or your spouse be a real estate professional is not a get out of jail free card anymore. Okay. It means that you get a jail free up to that $500,000, but then you're limited and they carry over to the next year. This has now been extended through 2028. So for all practical purposes, consider it permanent. Garrett, anything you want to add there?
Yeah, I think that was a good summary. I think overall, it's from a policy perspective, this has been a provision that a place where policymakers keep going back to the well to get revenue. Of course, this was something that was put into place originally in the 2017 tax law and has been extended a couple of times now. So I think you're right in saying that, yeah, formally it's through 28, but I expect there's going to be a push to extend that further or make it permanent at some point.
There's actually no good policy behind this that I can see, Garrett. It's just like you say, it's just going to the wealth to raise revenue. Right. That's all it is.
That's right.
So let's talk about the corporate taxes, because there's two provisions, corporate tax provisions, that probably don't affect very many people on this call directly, but probably affects everybody on this call indirectly. So the first is the 15% minimum tax on book income. Now, this is, Garrett and I have talked about this in my podcast. This is very troubling to me because basically you're letting accountants decide what your tax liability should be for big corporations. And I think that's typically a bad idea, being an accountant. But what it means is that you know, a lot of those companies that your 401k may be invested in, or you're invested in, will have a new minimum tax, and some of the tax benefits that they've been taking advantage of are going to go away. Garrett, what do you see on the horizon for this?
Yeah, I think the big thing on this tax, or the context, of course, is it's a new design, right? And it's pretty complicated. It's only adds up about 11 pages in the legislative text itself, and a lot of the details are going to be ironed out by Treasury and the IRS over between now and the end of the year. Is going to be the race, and I expect it'll continue into next year because a lot of little details will need to be ironed out. One simple one is there are rules on when large corporations fall into this tax regime, but they actually delegate when you fall out to Treasury. So they'll have to figure that out. Something as simple as when would a large corporation, it's set at a revenue threshold, when would they earn, basically become small enough to fall out? That's not specified in the legislative text. And already they're actually, in Congress, there are folks pushing Treasury to consider small items and make sure that they're clarified. Just an example of how messy this gets. There is an exemption for foreign tax credits in the legislation for corporations, but they didn't consider the fact that there are timing differences in the fiscal years between countries, and that can actually generate potential tax liability that they need to deal with. That's just one example of dozens that have been highlighted that will have to be dealt with in the regulatory process. Yeah,
I think this part is called the In-House Tax Professional Full Employment Act.
Yeah,
for sure, because it's going to be very, very complex. How about the 1% stock tax on the value of stock repurchases? Now, the minimum tax only applies primarily to corporations with profits over $1 billion, unless they, of course, did their headquartering overseas, and then it's only 100 million. But the 1% excise tax, this applies to all public companies, right?
That's right. Yeah, it's aimed at domestic public traded companies and the activity of foreign multinationals to the extent that they engage in repurchases in the U.S. And so it's pretty broad based here. A lot of uncertainty about how much revenue will be collected here, how much it might impact repurchases overall, given the amount. I think the political question is, will it stay at 1% in the long run, or will this become another well for revenue? Will that
always the challenge? It's a slippery slope. Once you open the door, it's like the camel. You don't let the camel's nose get into your tent, because pretty soon the camel's taking over your tent. And that's the same thing with tax policy. A 1% excise tax doesn't sound bad, but that's easy enough from that 1% to go to 3 to 5 to 10, eventually 15% or more, and then you've got a major issue on your hands. All right. Let's talk about the good news before we talk about, well, you know what? I'm going to flip that. Let's talk about the really bad news first, Garrett. And then we'll talk about the good news. So we'll talk about the good news, which are the tax credits, but I want to talk about the really bad news, which is the IRS. So right now, Garrett, do you have more recent statistics than this? The last I heard, the IRS is still answering only about 10% of its phone calls.
That's right. Yeah. Originally, I think last year the total was 13, and then actually dipped to 10%. And I think that's still roughly where they're at. And they're still dealing with a backlog of a couple million returns. We actually have disagreements about this between IRS Commissioner Rettig and the National Taxpayer Advocate at one point earlier this summer, where Rettig was claiming that we had caught up, and then turns out we actually still have a backlog they're dealing with.
Well, if nothing, he's quite a proponent of the IRS. So, right. Mr. Rettig, interesting about face for somebody who for years and years was fighting the IRS. So, and by the way, his term is up next month, I believe. And so we'll be waiting on a new commissioner. But here's what this bill does. It provides $80 billion to the IRS. Now I want to explain what it does do and what it doesn't do. There's been a lot in the press about the IRS hiring 87,000 gun-toting agents. All right, this is not true, right? What they expect is to hire 87,000 new employees over the next 10 years. Of those, let me explain real quickly the difference between an agent and an auditor, because this is very important. An agent is law enforcement. An agent is somebody who carries a gun. Now, they don't normally have to use their gun. That would be only in a very extreme situation. Typically, they're the ones, if you're a business owner, you don't pay your employment taxes that you've held from your employees, which, by the way, doesn't belong to you. It's not your money, it's your employees. And you don't pay it, and you don't respond to requests from the IRS to pay it. You may get an IRS agent showing up on your door to collect it. Okay, so they're the ones who collect. They're basically IRS collection agents, and they're the ones who only collect if you are really, 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 really bad. And there's currently, I believe, Garrett, only about 2,100 of these, right?
Mm-hmm. That's right. Yeah, it's a small fraction of the overall IRS workforce.
Right, and I would expect that it'll stay a small fraction. I mean, that's really not the issue. And so the other 85, and they're already hired. So I would expect most of the 87,000. Hopefully, there will be some customer service people, but we know that a lot of them are going to be IRS auditors. So here's how the $80 billion goes. It's basically over 10 years. So it's $80 billion over 10 years, which, Garrett, I believe that roughly doubles their budget, doesn't it?
That's right. Over those 10 years, it roughly doubles it. It'll be about, in the last year, it's about 50% more based on the growth over that time period. So it's a substantial increase.
Yeah. So it's basically doubling their budget. And then what the law says they're supposed to do with it, and this is in the law, is of that 80 billion, less than 5% goes to customer service. That's basically $3.5 billion goes to customer service. So I project, this is my projection, Garrett. If you have a different projection, I'd love to hear it. My projection is we'll go from 10% of phone calls answered to 20%.
Yeah, I think that's a reasonable expectation. I think it's moving it a little bit, but not where we'd like to see it, right? And that's the big missed opportunity, I think, here.
I think Garrett, there are two big missed opportunities. That one and the other one, which is technology. So this bill directs just over 5%, 6% roughly, to technology, $4.5 billion. So rather than, and technology is where the IRS is. I remember when I was in Washington, D.C. back in the 80s, I believe they're still using a lot of the software that they developed back in the 80s. I had a buddy that lived down the street from me who actually worked on developing what I believe is still a lot of the current IRS system. Yeah,
that's right. And we've seen over the last 12 months in particular, just examples of this, right? I mean, and it goes on even little details of the IRS process, including the way in which they stamp and mark forms that they're working through is still about 20 to 30 years plus out of date. And of course, this is interacting with the shortage of workers, not just, the rank and file who are working through the backlog or opening up mail, but also folks who actually have the institutional knowledge of the code base, of the technology. They're actually, and of course, it's not one system, right? It's a patchwork of a few dozen different discrete systems that work together. And it's going to be harder for them over time as folks are retiring. There's been a lot more retirements over the last 2 years, as reflected elsewhere. And training people up on, say, on Fortran or any proprietary tech out of 30 years ago, it's going to become harder and harder as we progress, in the future.
Yeah, those people are retired. Yeah. They're on Social Security, Medicare themselves right now. So, all right, so that's a total of $8 billion. So that's 10%. Right. Now, $28 billion goes to basically what seems to be a slush fund. Basically, it says operations. What do you guys think that means? What do you think that $20 billion will go towards, Garrett?
Yeah, operations, of course, is a pretty, when you look at the IRS, budget specifics, it's a pretty large catch-all for, all the various sort of miscellaneous details as it relates to the, the operation of the staffing and the HR and the hiring, the actual, the building and facilities that are hired. It's not that are set up. It's not just, of course, the IRS building in DC. They have several processing centers across the country. They've opened more in an attempt to open this backlog. So a lot of that is going to go to that kind of infrastructure that's supporting some of this work that taxpayers deal with on a day-to-day basis. But of course, we're still waiting on the plan, the specific details of how they're actually implement this. That is actually due, or is expected anyway, to Congress and released to the public early next year. And so we are hoping to have more detailed accounting of that kind of support, how it'll be used in the next 6 months.
Yeah, hopefully, I'm sure the new commissioner, that will be their first job. I'm sure they're already working on it, but I presume the new commissioner, their first job will be to come up with that projection and how they're going to use those numbers. There is a small penalty, but it's really tiny if they don't meet their target. So they lose a couple of $1 million, but that's about it. Now let's go to the big number, $45 billion for enforcement. I know how I would use that for enforcement. Garrett, how do you think they'll use it for enforcement?
Yeah, so I think there's a couple of things going on here on the enforcement side. One, of course, is there's been a lot of political and policy focus on the distribution of that enforcement, right? Who is actually going to be impacted by the enforcement? And of course, it's being reflected in the fact that President Biden, when he was elected and working through these tax changes, committed to not raising taxes on those earning less than $400,000, and that has been extended to some extent on this, auditing and enforcement question, particularly as it relates to audit rates for those under 400,000. And so they have Commissioner Reddick and others have committed, if not formally through the law, elsewhere informally, that hey, we're going to do our best to try to focus on folks at the top. When you look at the what is known as the tax gap in tax wonk world, which is basically just the difference between taxes formally owed and taxes actually paid. When you look at that, most of that tax gap is coming from sources of income that are not formally reported to the IRS. So it's not, folks reporting wages or W-2 income or income like that, right? It's income that's not reported, particularly through, fairly complicated pass-through entities, particularly, limited partnerships and other entities. And I think that's going to be the place they think they're going to commit their resources, or that's the argument, is that's the place we need to focus on. But I'm sure as we'll discuss, right, there's lots of wrinkles in that, lots of nuances. But that's where they're trying to at least politically emphasize the message, because that's where a lot of the tax gap is.
Yeah. Now it's interesting to me that Janet Yellen immediately after this was passed came out and said very clearly that it's the proportion that won't increase. It's not the number of audits that won't increase. So Garrett, what does the Tax Foundation estimate is the current number of audits that are on people making less than 400,000?
That's a good question. I don't think I have an exact number on hand, or I'd have to go back and see. I know there was an estimate by, and this was something that come up also in the political debate. I think it was through Treasury.
Joint Committee on Taxation actually came up with an estimate.
That's right. So Treasury has one, JCT has one. But overall, I can tell you that the overall direction of audits just across the board, and including for low income folks, has gone down, particularly over the last 10 years, as we've seen their workforce shrink overall. There has been some discussion, and I think it's an interesting debate about at the very low end, we're not talking about business taxpayers, we're talking about folks who claim the EITC and certain tax credits.
That's the earned income tax credit.
Right, the EITC and CTC. So they are very complicated, and there's a very high error rate, right, as it relates to.
Well, and there's a very high fraud rate. Let's be very clear about this, is that this is, anytime that you have a tax credit that's refundable, there's going to be a high fraud rate. I mean, because you don't have to have tax in order to get the earned income tax credit. All you have to do is, file a tax return. So if your return, for example, if you're, I don't know, let's say the IRS put something out on their website that listed personal information, and somebody actually got your personal information, either from the IRS or from your credit card company or something else, and now somebody's filed a return for you. Guess what? A lot of times they're claiming the earned income tax credit because they're looking for a way to change your address, and they want earned income tax credit because they want that money coming back to them. All right. So and that's about, as I recall, about 25% of audits are in
Right.
that
Yep.
low income category. About 90% overall, according to the Joint Committee on Taxation, are under 400,000. So
Yep.
you're going to see that 90%. I think that's going to continue. Here's another interesting number I saw, Garrett, that in 2019, I believe, there were 250,000 S corporations showing over $100,000 of taxable income and no wages.
Mhm.
So to me, that's easy.
Yeah.
That's an easy place to go, and they ought to go there. Frankly,
Right.
I mean, this is something that is pretty egregious. You know, you've got your business and you're not paying yourself a salary. You're taking on distribution, so you don't pay any Social Security taxes. Well, that's pretty egregious. The courts have been pretty clear that you can't do that. And so, you know, there are a lot of areas here. Hopefully the IRS will do that. Here's my concern. The IRS has taken the position recently, and here's a question we got on conservation agents, for example, where the IRS doesn't like a certain provision in the tax law, and they think it's being overused. Okay, they would use the term abused. I'm going to use the term overused, and rather than address each one individually, they'll just go through and immediately throw it out. So they won't even. The audit process is really for them to gather data rather than for them to actually work something out with the taxpayer. And the concern I have, Garrett, of course, is that, and this is the concern everybody should have, frankly, is that what they will focus on, first, they're going to focus on documentation. So everyone, you need to maintain good documentation, because that is the number one thing the IRS looks at. They look at documentation. They don't care if it's a legitimate deduction. If you don't have legitimate documentation, it's not legitimate. Okay, documentation is a requirement. And by the way, your credit card statement does not qualify. You have to have actual receipts. Now, you can do scanned copies of the receipts. In fact, I highly recommend it, since the rest of them fade over about 6 months. But you know, you do have to have the actual receipt. So documentation is going to be critical. And the other thing is that you're going to understand that, you know, your chances of getting audited are going way up here. So make sure that you're prepared. Make sure that your tax return is prepared in such a way that you have a lower chance of being audited. Make sure your tax preparer is comfortable representing you before the IRS, that they're not afraid of the IRS. I unfortunately find that many of my compatriots, CPAs included, EAs, CPAs, other tax preparers, are scared to death of the IRS. And my honest opinion is, if your tax preparer or your tax advisor is afraid of the IRS, you need a new tax advisor. And by the way, if you are looking for a new tax advisor, please feel free to go to wealthability.com/schedule call. We're happy to help you find one. We don't charge for helping you find a tax advisor. We have a network of 60 firms across the US and into Canada. So we're very happy to help there. Here it is. It's up in the thanks, Andrew, for putting that up in the chat box. But I just want to make that point that, you know, a lot of people have gotten, I think, a little complacent, Garrett, because there haven't been very many audits. I was on a call with a mastermind group, and these were pretty successful business owners. And I asked how many, and it was less than 10% had ever had an audit. Okay. And you know, and they weren't 20 years old. And I'm going, the question now is not, have you had an audit or will you have an audit, but when will you have an audit? Because I think the chances are much greater, and they're more likely to come in with a checklist. Remember, these auditors, they're not going to get CPAs. They're just not. They can't pay enough to get a CPA. They can't pay enough to get a really highly qualified person. So what's going to happen is, I would expect, Garrett, that they're going to take their current audit group, they're going to move them into supervisory roles, and then they're going to bring in junior auditors behind them. Does that make sense to you?
I think that's right, because they're really going to have to scale this. There, of course, there's been a lot of attention paid to, you know, folks focusing on the, you know, most sophisticated, you know, tax situations and places there. But you have to remember, I think you made this point well, right? Like, the IRS is going to be going for ROI from their perspective, right? Not from the taxpayer's perspective. So that means, to some extent, it also means scaling this up. And that tactic that you just mentioned, I think will be one that they'll be looking at.
Right. So what I'm seeing is I think they're going to come in, you know, they currently now have audit guides for a lot of different areas, but I would expect them to come up with checklists. And if you don't meet their checklist, then they're going to disallow it. I think that is the easy way to do it. Now, for me, if I had $45 billion to put towards enforcement, I would put $30 billion of that towards technology, because I think technology can do way more for enforcement. You can, I mean, Garrett, you and I know we're in an age here where technology can do so much and be so efficient and so effective. New York has been very successful using technology, even to the point of discovering that if a grocery store has sold a certain number of lottery tickets, they should have a particular volume of sales. And they're very successful collecting money on that. It's been very good for them. So we'll see. We'll see if they do it. But my recommendation is very much be ready for it. And it's going to take a few years. Garrett, how long do you think it's going to take before we start to see a real uptick in audits?
Yeah, I think based on just our sense of looking into this, some of the historical patterns, as well as what CBO expects for when the revenue starts coming in, which is a good way to back out. I think about 3 years is about right. Though I think that expectations part is important, because folks are going to be going in the next couple of years and they may not notice much change, right? And they're going to be thinking, oh, well, so this isn't a big deal. Right. And then you get 5 years into it and the audit rates start going up. And that's when you really have to be ready to deal with, folks who may not be looking at it from the taxpayer's perspective, or may not have all the information necessary to evaluate your tax situation. So being able to not just work with them, but then navigate the process if you need to within the IRS and even in the court system if need be, to do that is important. There actually been a couple of anecdotes, and they're just anecdotes, but I think they're important, of cases where folks have where it's pretty clear the law was actually on their side as it relates to their tax situation, and they were dealing with folks, even tax lawyers of the IRS, who were just couldn't quite get it, and it required them going to tax court to actually deal with that, and it was dealt with there, but it required them to not give in and just pay, which is always the temptation.
And that's very expensive. I mean, we saw a court case just the other day where a taxpayer clearly had all of the documentation, everything on their business expenses, and they've been disallowed, and they ended up in court, which, right. my wife is also a CPA. We're talking about this, and she's going, how in the world does something like this end up in court? Right. And I can tell you a number of audits I've handled over the years, and I've been fortunate not to handle too many in my 40 years, but I've handled enough. And I can tell you that I've had to show an auditor exactly what the law was, because I had one, it was a partnership audit, and they said, well, here's, you can't do that. And I said, let me show you the regulation that specifically says I can do that. And in fact, it's the only way I can do it. And so that's why it's important to have that really good tax professional on your side. And by the way, no income requirement. There's a question, no income requirement for scheduling a call. We're all takers. We're just happy to help if there's a way we can help. If we can't help, we'll tell you we can't help. Okay. But we do have a wide range of people. And that's why we have a network, because not everybody, can handle, the very sophisticated taxpayer. But also, not everybody can afford to handle, the beginning taxpayer. So we do have a very wide range. So that's why we do that. So what I want to get into next, Garrett, while we've got a few minutes here, is let's talk about the credits. So let's start with the low-hanging fruit here. Let's talk about the electric car credits and how those have changed. So we know that beginning in 2023, I believe there's no more limits on how many cars a car manufacturer can sell. So Tesla gets their limit lifted. This was a huge boon to Tesla and to General Motors, who are and Nissan. I think those are the three big winners. Probably Toyota wins on that one too, I think. But they're the big winners on this. But at the same time, now there's a limit on the price of the vehicle. And interestingly enough, immediately after this passed, a couple of the car manufacturers raised their prices by, oh my heavens, what do you know, $7,000 to $8,000.
I wonder how they got that number.
Where did that come from? So as I understand it, Garrett, we have a $55,000 limit for cars and an $80,000 limit for trucks. First question I have on this, just a little bit of detail. on the cars, is this indexed for inflation at all?
Well, that's a good question. I do not believe it is.
I have
though.
not seen it.
Yeah, I believe it is just, and often credits like this aren't, so they're less likely to be indexed than other things. But that's something that's that if inflation stays high, that's going to be important, right? Because it's going to erode the value
for
over
sure.
time.
And the second question is, what constitutes a truck?
Oh, I don't have that offhand, but that would definitely be something they would have to, they probably already have in regulation.
Yeah, I haven't seen that definition. I haven't seen that definition yet. So that's something we're going to kind of watch out for, because, you know, obviously if you can classify it as truck, for example, we have a Tesla SUV. That Tesla SUV is not a truck for purposes of the bonus depreciation rules or the 179 rules,
right?
But it could be a truck for these purposes. So you're going to want to, that's a question to ask, is how do I get my vehicle to qualify as a truck? How do I get that $80,000 limit? If I'm paying $75,000 for my car, I want to make sure that I've got the $80,000 limit and not the $55,000 limit. However, it may not matter anyway, because we have new income limits, and they're very small limits, folks. So for a single person, it's 150,000. And married filing joint, it's 300,000, double that. And then head of household, it's smack in the middle, 225. So, and half those, by the way, for the used car credit. So, Garrett, can you walk us through kind of when those dates happen for that income? Is that's like this year, right? Already?
I think that's right. Yeah. So it's reflected in the income in the year in which it's going to apply. And so for a lot of folks here, it's going to affect them. Of course, and then the other major uncertainty in addition to the income limits, of course, is the sourcing rules, which is going to start, which doesn't kick in immediately, but
that starts next year, right?
Exactly. Yeah. So with that, and that was something that Senator Joe Manchin and others were pushing for, which the policy rationale is we want to make sure to be sourcing the components of both the vehicles and the batteries, especially in North America. But what that means is there actually are very few, if any, depending on the category of the vehicle, that actually qualify at this point for the sourcing rules, which become more and more strict over time. And so one concern that advocates and the car producers have is in the next couple of years, there may not be many vehicles that actually qualify, because most of their sourcing is not in North America right now. And the idea is this will encourage them to actually start producing in North America, but that's going to take time.
Yeah. So if you're thinking of buying an electric car, you may want to think about doing it right away.
Yes.
Frankly,
yeah,
this would be the year. And remember also that one of the planning aspects here is, we've got this $300,000 limit for married filing joint. It's not that hard to get your income down to $300,000. Okay. This is modified adjusted gross income. So it's really not that hard, whether it's you're investing in real estate, even you have a business and you go put solar, which we're going to talk about next, on your business, you get a deduction for the solar panels. There's all sorts of tax things that you can do. You can do a qualified plan where you defer money, and that gets your adjusted gross income down. So what I would start doing is I would start planning now. But if you're going to buy that electric car and you're going to do it now, of course, it's tough to get them. It's tough to get them right now because there's a lot of demand. But remember that that's a credit that it changes significantly in 2023. And actually the income limits, I believe, apply in to vehicles purchased after the date that they give guidance on the electric vehicles, which I don't think they've given that guidance yet. Garrett, I haven't seen it come out, but maybe you can do a little checking while I'm talking here. But I don't believe they have come out with that guidance. So I think you can still get it, but we're getting close. I think you're going to come under that threshold if you don't act quickly. So if you're in the market for an electric vehicle. Now let's talk about the big one, which is the solar credits. Because solar credits, I am happy to report that the 30% increase is retroactive to 2022, right, which means I get a 4% higher credit for my building because I'm putting on my building this year than I would otherwise have gotten. So I was expecting a 26% credit. I'm getting a 30% credit. Hallelujah. This is awesome. So goes to 30% for both businesses and for individuals. However, commercial projects, which a business would be, commercial projects do have this labor law limit. Okay. If the commercial project's over 1 megawatt. Now, 1 megawatt's actually a pretty big project. So I know my panels on my my little office building are not over 1 megawatt. They're not going to produce a megawatt of electricity. But do know that if you're under a megawatt, you don't have to pay those enormous labor union rates. Okay. Just know that those people will not have to pay those rates. That's a big exception. It's very, very important because you want to make sure that you get the full credit, because if you don't get the full credit, you only get 6%, not 30%, 6%, not 30%. And so that's a big deal. If you're looking at a major project, you need to know that they have to pay what they call, what's the term, Garrett?
Not sure what you're thinking.
Prevailing rates.
Oh,
you have to pay prevailing rates. Whatever the union would pay is what you have to pay, and you have to have apprentices, and there's all these other things. So do know that that's involved there. Some of the other provisions on the solar don't apply until next year. So we know that we did get the 30% increase this year. So we're going to get that credit this year, but next year it stays at 30%, and it stays at 30% through 2032, right?
That's right. Yep. Through 32. And then the other aspect of just the broader energy credits, and this is true of energy producers especially, is they're trying to move. It's sort of a hybrid if you look at it, where the first 3 years it's extending a lot of the incentives that existed for solar, wind, geothermal, other forms of renewable energy through 2025 or so. And then after that, they're trying to move to a more technology neutral approach, where they're not trying to incentivize particular forms of energy, but more the results of trying to lower emissions. And that's especially true in the electrical sector, because of course the sticks that were being proposed were thrown out either in court, if you're familiar with the Clean Power Plan, or was taken out of the proposal over the last year. What that does mean is there's going to be, and then those incentives actually in the electrical sector, which won't impact individuals here, but are helpful to know, are actually going to be tied to the targets related to emissions reductions in that sector. So, there's of course a clean energy production credit and an investment credit for those folks. That's going to go through either 2032 or if they've reduced their target, which I think it's 30% reduction relative to, I think it's 2005. It might not be, it might be this year. It's either that or 05. And so that's important to know. Most of these credits though overall expire either in 32 or 33, depending on the credit. So the idea here, of course, is instead of dealing with this on an annual basis or every 2 years, right, there's going to provide more certainty for the market, of course, but we are going to have to revisit this because most of this is not permanent, but it'll be in the next 10 years. And
do we have made in America parts of this too, right?
That's right. So that actually is pervasive throughout most of the credits that we're seeing here, both made in America, also pushing for prevailing wage requirements there. And that's been a policy tension, right? Where I think the goal was, we want to make, trying to connect creating good jobs for folks with the shift to renewables. At the same time, that may limit some opportunities that folks are looking into where they're right on the edge, right, of this making sense economically, but you throw in those rules that might actually slow some folks down. So this was an attempt to try to balance those things out.
Great. So we have a question on how this actually works. So I want to give an example. I'm just going to do a little side by side here. So I'm going to share my screen here and just kind of walk through the difference between doing it in a commercial setting, like your office building, or by the way, your rental real estate would qualify in this case, and doing it personally. If you look at, so let's say over here, you're doing it on your personal home right here, and you're putting your panels up here. All right. So in this case, what you're going to get is you're going to get this 30% tax credit. Now, remember, a tax credit is different from a deduction. A credit is dollar for dollar in your pocket, as long as you have tax. This is not, now I'm going to go back to you, Garrett, on this. It's not refundable. However, there is a provision for you to apply to actually get money directly from the government instead of taking the credit, correct?
That is right. Yep. So direct monetization of the credit directly.
And that begins in 2023 or 2024.
I think 2023. I have to go back and actually check that right now.
That's my recollection. That begins in 2023. So that means that if you pay $50,000 for your solar panels, then you're going to get a credit of $15,000, and you're really only paying $35,000. Now, I've had solar people tell me yes, and they know this, so they've actually built that into the price. So, but that is the way to look at it. So when you're looking at your, what's kind of return am I getting? You need to focus on this number, not this number, right? This number is not important to you. What's important to you is the actual amount that you put in to the project. Now let's take over here. Let's say you put it on your commercial building, right? So you got this commercial building here. And you've got solar panels up here. Now you get a little different situation going on, and it's a really sweet situation. So let's say in this case, we're going to put $100,000 on, because we can put more on because we got a bigger building here than our house. We've got more electricity that we're using. We're going to get, again, a 30% credit, which means we're going to get $30,000 of a tax credit. Okay, which leaves us with $70,000. Only it doesn't, because remember, this year we get 100% bonus depreciation for equipment. Okay, well, this is equipment. And so what we get is we actually get a deduction, not for the 100,000 though. We get a deduction of $85,000. So over here, we're getting an $85,000 deduction. So if you're in a 40% tax bracket, now this is a deduction. This is not a credit. So it does matter what your tax liability is. Okay, so somebody in a lower tax bracket gets less money than somebody in a higher tax bracket. But let's say that you're here. So that's $34,000 of tax benefit. You're in 40%. Between your federal and state. Now, a lot of states allow bonus depreciation, so it would be allowed for the state too. That means that you get another another $34,000 off, which means you're really only paying $36,000 for this $100,000 of solar panels. Literally, the government is paying you to make this investment. Now, consider if you were to borrow 50% of it, you actually get money in your pocket on day one, right? So if you borrow money to pay for this, then you actually end up in the black, as we would say in accounting. You actually end up with a net positive cash flow day one. So literally the government's paying you to make this investment as long as you use debt, and then they'll pay for the whole thing. Now, again, when you're looking at your return on investment here, you're looking at your return on investment on $36,000. You're not looking at a return on investment on $100,000. So if you had a 7% return here, now you have a 20% return here, right? It's gone up that much because of the government's incentives. So when you're looking at solar, I know a lot of people don't like solar. I'm going, what is not to like here? A 20% return on investment, and you know it's going to happen, right? I mean, there's not a lot of risk here. You're going to use the utilities every year. I mean, in Arizona, it's always hot in the summer. It is. And it's always sunny 300 days a year. In Colorado, it's always cold in the winter. It's always sunny 300 days a year. So, you know, if you're in the right area, really ought to be considering looking at solar. So Spencer, here's your answer to your bonus depreciation. But here's how to look at solar from an investment standpoint. It's really not that bad. These, by the way, these are my numbers on my project. They're 7%, and you know, I actually figured it's about just over 7%, about 22% total. And I love it. I just love it. So I do go through that, by the way, in the energy chapter in the Win-Win Wealth Strategy. I go through a solar example and actually walk through this. So you've got that. If you've got the book, you've got access to that. Anything you want to add there, Garrett?
Yeah, I think you covered it well. I was just going to say this is a great example of how this policy is being used to try to incentivize folks to get into solar. That's the whole idea here is government providing incentives here so that folks can where all of a sudden projects that didn't make sense before prior to these credits all of a sudden do. I think the biggest barrier, of course, I'm sure as you've seen, is education, making sure folks understand it,
Right.
understand the implications for their situation. And of course, there is some, I think, benefit and something that we've been supportive of stabilizing these credits so that it gets more confusing than otherwise needs to be if the rules are constantly changing, especially if there's timing related challenges with certain projects. So having this extended out, over the next few years will help folks, because maybe it doesn't make sense now, but in 5 years it might, depending on the nature of their project or even where the cost of solar goes, which we're expecting will continue to potentially decline as we've seen over the last couple of decades.
Exactly. So the one other area that I think's been interesting, Garrett, is the home energy credits are completely changing. We used to have this $500 lifetime limit. Now we've got a $1,200 annual limit. So that means, you can put, new doors, new windows. Now it's not frankly, compared to the cost of the new doors, new windows, it's not a lot of money, but remember that it's there. So when you get those little tags from your window company, because I put new windows on my house, so I know all about these tags. Those tags are so that you can claim these credits, and they're pretty, again, up to $1,200 annual credits. And so you can kind of spread over. So you want to do, some of your windows this year, some next year, doors the following year, you can do that. And these go out also to 2032. So, Garrett, I actually think this is a really nice, and it's about time that they increase the amount here.
Yeah, I think it makes sense because that's one part of energy use that a lot of folks don't think about as much, right? Which is conserving energy and energy efficiency. Right. And so this is something that's going to, there's a lot of work that needs to be done there, and this is a way to try to encourage folks to do their part on their own homes. Yeah,
we certainly feel it in Arizona. So, yeah. And I will tell you, we've had solar on our house for the last several years, and it has made a huge difference. And remember, your batteries count as well. The batteries are probably the most important part of your solar energy because it allows you to use that energy when the sun's not out. So very, very important to make sure that you're, including batteries in your thought process. So with that, Garrett, anything that you think I missed here that we need to cover before we go to questions?
I think we covered basically everything. I think the last thing, it's a very small thing, but worth mentioning for people, for folks working with small businesses, is there was some increase in the research and development tax credit. Famously, a complicated credit for folks to navigate, practitioners and small businesses, where they basically increased the amount that can be claimed against payroll taxes. It's especially helpful for businesses that don't have income to offset, but do have payroll. And so that's something to explore, and probably hasn't been advertised as much. So folks who do just happen to have R&D
point, and that went up to $250,000, if I recall.
That's right.
So that's money that you can claim against payroll tax. You don't have to have income tax liability in order to claim that. Now, if we can, Garrett, one thing I would like before I want 5 minutes before we go to questions, folks, if that's okay. I want to talk about things that are expiring. Can we talk about some of the provisions of 2017 that are beginning to expire, because they begin to expire next year? And the first one, of course, is bonus depreciation. Bonus depreciation goes to 80% in 2023, 60% in 2024, and after that, it's 50%. And so that bonus depreciation, that's been a big deal for real estate. It's been a huge benefit for real estate. It's been a big deal for manufacturers. In fact, in this latest bill, they made a specific provision on the minimum tax not to include bonus depreciation as an add back. So I thought that was very interesting. That was actually a Kirsten Sinema requirement at the last minute. So what else is expiring? And do you have a list of those expiration dates, Garrett?
Yes, so there's a lot of moving parts here. There's actually a couple that are worth mentioning that have expired or changed this year that may have actual that Congress is looking at potentially to change retroactively. The two that I'll mention, one is this is probably back to R&D, but important for larger firms, so still worth mentioning. Research development expenses were fully deductible prior to this year. They're now amortized over 5 years. Fairly unusual tax treatment in the context of U.S. history and internationally, but that is then that's something that if you remember the CHIPS bill or some of the R&D related efforts this year, policymakers are interested in changing that back potentially at the end of the year, depending if a political deal can be made. The other thing that's been mentioned that's going to affect businesses overall, any folks who have debt finance in their capital structure, is the interest deduction limitation. And so that was, at 30% of earnings before interest, taxes, depreciation, and amortization. It's now tightening to 30% of just EBIT. And so that is for folks in that situation, depending on the nature of their financing, could be a pretty significant change. There's been some effort to try to reverse this, but I think that's less likely. That kicked in this year
and that's big deal if you got a lot of depreciation.
Exactly. Yeah. So there's interactions with depreciation as well. And then, as you mentioned, I think the big one starting next year is the broader bonus expensing provisions in TCJA start phasing down. That's going to be, I think, from a policy perspective, tricky because policymakers always want to wait until there's a cliff or something dramatic. And unlike with some of these other changes, it's going to be a slow phase out over 5 years. So it might not be until later, in 2025, especially when other things phase out, where we might see something done here. So, I mean, I think we'll know more next year as this starts kicking in, but that's worth mentioning for folks who might be thinking it'll change.
I would expect nothing will change before 2025.
Yeah. Right.
On bonus depreciation. Let's talk about the estate tax. When does that phase down?
Yeah, so that is part of the broader individual changes. So that will basically the exemption will drop down from that a little over 11 million, 12 million as it's indexed up for inflation, back down about in half, and that will be at the end of 2025. So folks should be ready for that.
End of 2025. So here's what that means, folks. That means that assuming that it doesn't get changed, who knows who's going to be in the administration in 2025. But assuming that, you're going to really want to pay close attention. We're suggesting that our clients all look at their estate planning right now because you just want to be prepared. Remember, we almost had a big change last year. Almost. I mean, Build Back Better last year. And the reality is, if somehow the Democrats win the Senate and the House again, which is not entirely without possibility, if somehow they do, then you can absolutely guess that Build Back Better is back, and it's going to be back in huge force. So, and some of these things are going to go away. So I'm really recommending get ready, get your ducks in a row when it comes to estate planning. When you're looking at tax planning, there's 4 areas you need to look at. You need to look at your tax plan. You also need to look at your wealth strategy, though, because how you use your money is the biggest indicator of how much tax you're going to pay, is how you use your money. So your wealth strategy, your tax strategy, your asset protection strategy, because how you set up your businesses affects your income tax strategy, as well as your asset protection strategy. And then of course your estate planning strategy. So, or your legacy planning. So all of those need to be done together. So strongly recommend that you reach out to your tax advisors. And again, you can go to wealthability.com/schedule call if you need help with that. So let's go ahead and get to questions here. Deanna.
Thanks, Tom. Thanks, Garrett. We'll go ahead and take a question here first. First question is from William. Are conservation easements still attractive given the increased IRS enforcement budget and dislike for them in general? Thinking tax benefit versus audit risk. Well,
so I'll look at this first, and then I'll let you weigh in on this, Garrett, because I'd like your feedback on it. So all conservation easements are being audited. Okay, not 50%, not 80%, 100%. So there is no such thing as audit risk. It's audit risk is 100%. You're guaranteed an audit. So there needs to be money set aside to handle the audit in the conservation easement. Now, the good news on the conservation easement side is taxpayers have been winning in court, particularly if you're in the 11th Circuit, which is Georgia and that neck of the woods. and there's a lot of conservation easements in Georgia. So, but the 11th Circuit has a couple of very favorable rulings on conservation easements. And so the IRS has not just been winning hands down on those. They've been losing some cases. And so, that it's always a tough call. It is on the dirty dozen. Will it cause your return to be audited? Probably not, frankly, because they're not going to audit your return. They're going to audit the conservation easement return. So I don't think by itself it's going to cause you to be audited. Maybe in 3 or 4 years when we get an increased audit force, it will. Maybe it will be a red flag. But for now, I have not seen that personally. Garrett, any thoughts on conservation easements?
Yeah, I think your summary of the sort of current treatment is right. The big thing from a policy perspective is, that there's been push from folks like Senator Grassley and others to have some legislative input here, though that hasn't gone off the ground yet, and to clarify things. And one big concern, of course, is making sure whatever happens that we don't get too aggressive on retroactive application.
Right.
And so that it's clarifying the rules moving forward, which I think would be good. Could be a win-win for everyone. But that's going to be I think the battle line there is making sure if there is anything that's done, especially tightening any rules, that we're not imposing it retroactively on taxpayers who are operating in good faith in this world.
Awesome. Thank you. And remember, there's 2 big issues on conservation easements. The first is whether it is a qualified conservation easement. That should be put to bed if you've got a good company doing it. That should not be the issue anymore. The second is the valuation, and that's always an issue, and it's a legitimate issue. The IRS does not want to clarify those rules because they would have to live with them, and they don't want to live with them because they want to make sure that the valuation rules work for them when they need them to work for them. So that's something that you're probably just going to end up in court. So thank you for that question. I've got one from an anonymous attendee, and I'm gonna take this one specifically because I really like this question. It says, "Hello, Tom and Garrett. I'm not sure if it's that I am just overly cautious, but to me, it seems that the government is trying to get more working American dollars via a more powerful IRS through avenues such as the Infrastructure Investment and Jobs Act and now this Inflation Reduction Act. Do you think that the government will go after things like Section 469, real estate professional status, or other benefits for real estate investors?" You know what, Garrett? I'll let you take this first, but I have my definite opinions on this.
Yeah, I think you're probably best placed from the practitioner's perspective as to whether or not where the IRS will stand. I will say, of course, there has been the popular and political understanding of the tax benefits that real estate gets has been, I think, really polarizing, and I think that is an opportunity for, if there is a politicized IRS, for them to focus there. When you're thinking about, who are the folks they're going to be targeting. You also saw this in proposals that just didn't make it, right? So there was discussion about like on exchanges and other things being tightened up. And so I think that's a legitimate worry. Tom, you may have more thoughts on the specifics of how those provisions might be treated.
I do actually. This comes back to the idea of them auditing with a checklist. This is my concern. So for example, I actually think a bigger issue than real estate professional status, though, by the way, if you get audited and you claimed real estate professional status, you will get challenged 100% of the time. So you better be well documented on that. I mean, 100% of the time you will get challenged. Never have I seen somebody claim real estate professional and not be challenged in the audit. Now, so far, we've actually been winning those just because we've been able to prove, because we have good documentation. I think the bigger issue though, is going to be your cost segregation, your bonus depreciation. My concern is that they're going to come in and say, show me your cost segregation report. And they're going to have an amount that they're looking for. And if it's over that amount, they could easily just say, nope, they might say, we're not going to allow more than 20%. We're not going to allow more than 15%, even though I've seen legitimate cost segregations that got up over 30% for bonus depreciation. Because remember, we've got both the contents of the building and we've got the land improvements. So that is something that I think it's a really significant concern. So I would be paying attention to that. Another question, Chris Lee said, any oil and gas updates? There have been no changes, which is really interesting. Probably because of Joe Manchin, frankly.
Yeah.
If the Senate was to have 51, if the Democrats were to have 51 senators, Joe Manchin would become irrelevant, and you might get something passed. But as long as they're if they're at 50 or below, probably not going to happen. Do we have any live questions, Deanna?
We do, Tom. We do have a live question from Zara. Hi, Zara.
Thank
Zara,
you.
how are you?
Hi, good. Thanks, Tom and Garrett. My question is about solar on a rental property.
Yes.
It's held in an LLC. My husband and I are the only members. Will the deduction and the credit pass through and be applied against his W-2 income if I'm a real estate professional?
Yes. Again, subject to that $500,000 loss limitation rule. By the way, the solar credit is not subject to the passive loss rules. Thanks for bringing this up, Zara, because I forgot to mention that the credit is not subject to passive loss rules. The deduction is.
Yep.
So you get the credit no matter what, Zara, but the deduction you get if you're a real estate professional and your husband's income is not over 500,000. You'd get it up to the 500,000, but not over 500,000. Great question.
Thanks,
Who's next?
Tom. Up next, we do have a question from Mark. Who in the end pays for all the credits that the government is giving?
Well, that's an interesting question, Garrett. That is definitely a tax foundation question.
That's right. Yeah. So we're looking at, overall, there's like $330 billion plus of tax credits overall in this bill, and this also circles right back to Tom, the mention at the beginning about whether or not this changes inflation at all, because it all comes back to the bottom line of what the net sort of change of the deficit is, right? So we have these tax credits, which is all spending through the tax code. We have the ACA credits, which are expanded, more spending through the tax code. Then you have these major sort of offsets, the excise tax, the book tax, this change in the active the pass-through loss limitation, and that all sort of nets out such that over the 10-year window, for the most part, it does raise revenue more than it costs. The challenge is with that, we and even CBO find in their most updated forecast that it actually increases the deficit over the next couple of years. And so that's the concern about the inflation angle is, as folks start claiming these green energy credits, and this additional spending for the ACA subsidies, that's going to more than offset these tax hikes, which actually will take some time to roll in, and the IRS enforcement actually. And so that might mean that CBO finds that the impact on inflation is negligible, and if anything, we find it could have a slight increase, very small, but an increase in inflation in the short term. And so who's paying for it? Well, the first couple of years, it's going to show up in higher prices for consumers. In the long run, it's expected that revenue will even out and wind up actually reducing the deficit slightly, assuming that money isn't reallocated elsewhere through other spending, which is always going to be the temptation.
For sure. And a follow-up question is from Mr. Porto in Austin. Yes, hook 'em horns. Thank you very much. And his concern about solar because it's too expensive. Well, we just talked about how it's increased this credit, the EV credit, electric vehicle credit, already increased the price of electric vehicles already. So that was instant. That's called instant inflation. So we might just try to change it from Inflation Reduction Act to Inflation Enhancement Act, because that was literally instant inflation. Yeah. I've never seen any industry react so quickly to a credit. The question is, you always have to look at return on investment. It's always what's your cash on cash return. And, after taking into account the tax benefits, how much is it costing you and what's your return? So you have to look at things like how much is your utility bill? How many days do you have sunshine? How many, how good are your batteries? Okay. Batteries are, again, let me emphasize, do not go cheap on your batteries. Okay. They're the most important. Elon Musk has said this, by the way. Elon Musk has reiterated that the most important part of the whole climate discussion is batteries. And that's because it's very expensive. You lose a lot of electricity when you transmit it over long distances, okay, over the transmission lines. A lot of it fades off. And so what you really want is you want to have the batteries. And plus, of course, you have rainy days, you have snowy days, you have cloudy days, right? So you want to make sure that the batteries are good too. So I would just look at, again, always look at the return on investment based on your cost, not based on the total price, is the way I would look on that. Now, real estate. I've a couple of people have asked this question, Garrett. I'm going to ask you from a foundation standpoint. Do you see, let's think the unimaginable, but that we get 52 senators, Democrats, okay? And 52 is important, right? Because that takes Kirsten Sinema and Joe Manchin off the table. And the Democrats keep the House. If that happens, do you think we get some of these major changes that they were talking about, like eliminating 1031 exchange, like eliminating step up in basis at death? What do you think is going to happen there if something like that, if we got kind of the perfect storm?
Right. Yeah. I think some people were asking, does 1031 affect it at all? It wasn't in the IRA, and it was something that was proposed before. And I think it will come back again if Democrats have enough power in Congress. 1031, of course, it was proposed under President Biden, and I believe it's made its way into Congress, basically to limit the size of electronic exchanges. I believe it was about $500,000, which actually wasn't well thought out, because you have to think about the, of course, incentives to parcel out property over time. Right, having an arbitrary limit like that is doesn't really make a lot of sense. But I would expect that to come back. That's probably one of the single largest things in real estate specifically. When it comes to step up in basis, that's actually really interesting, because it's one of those things where politically, a lot of folks love to talk about it, love to point it out, love to call it a loophole. But when you get the devil's in the details, as is true of a lot of these things, the more as you get into the specifics of how you would deal with step up, and there's many different ways they proposed closing that. You start looking at small business owners, family farms, ranchers, folks who would be penalized. And we've tried this experiment before, right?
Well, yeah, I mean, it passed in 1980.
Yeah, that's right.
In the Windfall Profits Tax Act, right? It passed.
Yes. Exactly.
And then unpassed because it was not doable. It's just it's so difficult because we've had the system for so many years. So I just think that's I think it's impractical. One of the things to remember is that anytime this is a reason that, when you see legislation pass like this and you go, what didn't pass? Remember that part too, because remember that the IRS and Congress keeps a list. They keep a list of, and I'm sure you guys do too at the Tax Foundation, what are the biggest, what would have the biggest impact? And if I recall, the very single biggest tax benefit is actually the deduction for health insurance. Right? I mean, by a long shot, nothing else even comes close now that they've eliminated the state and local deduction, which was the other big one, right?
Yep.
So those really are the two biggest of all the big ones. But remember that they keep that list, and the more often you hear about it, let's talk about oil and gas. Okay, we have the depletion and the IDC deduction. Well, that was in President Obama's budget all 8 years to eliminate that. It's been in President Biden's budget every year to eliminate it. So we have 10 years now of budgets where it was intended to be eliminated. Now it hasn't been eliminated, but that doesn't mean it won't be eliminated. So you do have to keep a watchful eye on what is in there. Okay. You can't just assume that, oh, we got by, so we don't have to worry about it. We need to still pay attention.
Yeah, the other major thing that I think could happen that I think is politically doable and gets around some of these issues is just raising something as simple as raising the capital gains rates. They talked about that.
Right.
I think that will be back on the table. Obviously, bringing back the top rate. Those are very easy things that could get 51 or 52 votes in the Senate. That would have a material impact on folks who are doing their planning.
And certainly surtaxes. I think the most logical of the tax increases are the surtaxes on, people making more than $10 million. Because the reality is, just like the 1% stock buyback, probably not going to affect anybody. Nobody's going to change their behavior that makes over $10 million. Nobody's going to change their behavior because they got a 5 or a 10% surtax. They're not going to stop making more money or, working because of that.
The other interesting thing about it in this last proposal where that came up was it was actually assessed on AGI and on taxable income. So a lot of folks couldn't get around it by, trying to reduce their income down.
Well, yes. Although remember, all of our tax planning that we do, we want to focus on AGI. So we want to do that anyway. Right.
Mm-hmm.
And as long as, remember, in the business loss limitation rules, remember that that losses can offset business income 100%. There's no loss limitation there. So, what this is saying is that the government likes business from the standpoint of, if you make your money in business, you get different treatment than if you make your money as an employee, period. That's how the law works. By the way, in every country in the win-win wealth strategy, I looked at 15 countries. Every single country has these same rules. Okay. So, there you go. Had a question from Chad. He asked about the meal expense, the meal deduction. Thank you for bringing that up, because that's another one that does expire this year. So remember, we got this 100% deduction for meals at a restaurant for 2021 and 2022. In 2023, it goes back to 50%. So that actually is big. So enjoy your restaurant's expenses between now and the end of the year. Take your accountant to lunch. So Candy asked, so do you recommend getting solar for rental projects? I highly recommend looking at the numbers. Okay. That's what I have to look at. You always have to look at the numbers. Always look at the numbers. I just had a really positive experience with solar. I'll be honest. I've had a really positive experience with solar, and it's been very good it's reduced our utility bills tremendously during the summer. And I like the idea of it. I'll be honest. I do like the idea of solar, for that purposes. Eloy asked, if I have a W-2 for 2022 and I buy an electric car, will I get tax credits? Well, it depends on what your W-2 is, right? So it's the amount of your W-2. It's the amount of your, what they call modified adjusted gross income. Garrett, do you know the details between what's modified there?
Every modified is a little bit different, but am I there?
Yeah, you're there.
Yeah, I don't know off the top of my head. I can figure out though right here. I think it's usually it's just adding in things like interest income into Maggie, but that could be
oh, you mean tax exempt interest?
Exactly. Yes.
Got it.
I think it's something as simple as that. It's usually just stuff that's typically exempt like that added back in. That's how it's used in the ACA and elsewhere too.
Here are a couple of other questions, like what about the maintenance costs on solar panels? Any deductions? If it's a business, yes. If it's personal, no. Okay, so again, business versus personal. Solar screens, not sure what solar screens are. Now, if you're talking about solar screens on your house, that would be part of your windows. Okay, so that's part of the other credit. That's part of the credit for reducing your usage. And that, I believe that should be included in that $1,200 limit, isn't it, Garrett?
That's right. Yeah, and on the Maggie limit for the vehicles, it's AGI augmented by any amount excluded from gross income. So that includes tax exempt interest, foreign earned income, things like that. Mostly for folks who will be hitting those income limits for the electric cars. Great.
Then a couple of other solar. I'm going to keep going on these solar. Since we're on this, one says they want to put solar panels on the dental office. If they produce more solar than they use and they sell it back to the grid, it's taxable. That's okay. But I actually like, a good solar company will actually maximize the amount for, help you maximize the amount. You don't really want to sell it back to the grid because unless you're in Texas, you don't get paid a lot for selling it back to the grid. Does the tax credit apply to batteries? It does. It applies to the solar batteries. It absolutely applies to the solar batteries. And batteries, so they're getting better. I know I've had some failure in batteries. They're hard to get actually right now. So you do want to start working on that. Mark says, being that all tax laws start in the House of Representatives, everything will be on the table if the Dems hold the House. Yeah, yes and no. I mean, you know, if it's still 50-50 in the Senate, you still have Kirsten Sinema and Joe Manchin that are going to hold things up substantially. Yeah. And especially if Joe Manchin does not get his bill passed on, you know, the Democrats are talking about holding that up. That I got to believe. Can you talk about that for a second? Because I think that would be the dumbest thing they could do.
I think that's right, because basically the agreement that came together between Manchin and Schumer in August was predicated on agreement to hold a vote and pass permitting reform. So reform to open access for oil and natural gas, and because there's a lot of red tape related to a lot of that. And if that, there's going to be opposition, of course, from skeptics of that, or don't want to see that happen, but that's going to make it a lot harder. It's going to be a poison pill for any future negotiations if Dems hold both houses. Also, the quick note on the taxes starting in the House, that is technically true, but the Senate can actually take any bill the House passes and amend it and completely change it, and the House can actually pass it later.
The Senate, right? Yeah, so that's technically true, but it's not really true. That's right. Is really what it is. Somebody asked a question. Matt asked a question about, okay, do cars, you know, how do electric cars work? Do they work the way the same as solar for the tax benefits? And the answer is no. So let's say you bought an electric truck. Okay, you're going to reduce your basis by the credit, but then you get to deduct the whole thing. You don't have to reduce, you don't get to deduct half of the credit like you do in solar. Okay. You don't get that extra bump like you do in solar. You reduce your basis and you get to deduct the rest. So if you bought a let's say you bought a $77,500 truck, you get a $7,500 credit, you get to deduct $70,000 on that truck if it's over the $6,000 limit. Home office. Yeah. I mean, on a home office, same thing. I mean, you would get a percentage of that on your home office. You get a percentage of the deduction for the solar panels on your home office. Well, I say that, but not really. And here's why, because if you use it for your home at all, you don't, you lose that benefit.
Yeah, that's my understanding, is it has to be a really discrete.
Yeah, it has to be solely business.
It has to
be solely business.
Yeah, and also it does not, that deduction does not apply for employees who are using home offices, just to be clear.
Yeah, just like anything else, employees do not get any tax benefits for home offices. That is a thing of the past. So if it's installed on a rental home, you do get, I mean, so understand, this is something that's misunderstood all the time. A rental property is a business. Okay, it's a trader business. So you get all the same tax deductions, business deductions. You have some limitations because of the Section 469 rules, the passive loss rules, but you get basically the same deductions. So that means you would still get, you know, if you put it on a rental home, you'd still get to deduct the solar panels. You still get the credit, the business credit for the solar panels. I mean, a rental property is, technically you're in business, you're in the rental business. And that would, by the way, the same would be true for an Airbnb. Okay. Let's say you have a vacation rental, which by the way, isn't even subject to the real estate professional rules. Okay. It's only subject to the material participation rules. So you get it on any business. All right. Any business, but you can't have personal use. Okay. So it's either all business or it's not business and it's personal. You still get the credit the same way either way, but you do lose the other tax benefits for the business. I've got to go back to Florian because she asked the very first question. She goes, okay, so this has nothing to do with what we've been talking about, but I'm going to answer it because thank you for asking a question right up front. Really appreciate it. The question is, let's say you take money out of your IRA or your 401k and it's taxable, right? Or you roll over into a Roth. That's taxable. How then can you offset that income? And really the way to do that is use the money. If you take it out, use the money for real estate, use the money for oil and gas, use the money for solar, okay? And get the tax benefits there to offset the tax you would have paid. I mean, that's really the answer there. It's just like anything else. You can always reduce your tax. Now you've got a limit. You got the $500,000 business loss limitation. That comes back to the business loss limitation. So now on UBIT, which is unrelated business income tax, we would have to have a whole separate discussion on that. All right. That's a whole different issue. But absolutely, we do have a lot of, you follow up with, can an experienced real estate CPA do that? Help you with that, and that absolutely. So just go ahead and click schedule a call, WealthAbility.com, schedule call, and we're happy to help with that. So thank you so much, Garrett. It's absolutely been a pleasure. Any final words for people on the call here?
Yeah, I think overall with this legislation, I think you summarized it well. I think in our discussion about being prepared and proactive about what this might mean for folks over the next couple of years is going to be really important. Lots of little details in here that can get lost, both carrots and sticks from the the tax changes, and
Right.
It's good to know both of those. So I think it's a good departing message for folks.
Yeah, and so just remember that this is why we plan all year round for taxes. You don't want to just wait until November, December and do what's called year-end tax planning, right? We need year-round tax planning because these things change all the time. These things change all the time. So we need to make sure that we're constantly planning. Don't talk to your tax preparer, your CPA once a year when you do taxes, or twice a year. I would suggest talking to them at least 4 times a year. Just remember that the more prepared we are, the better we document our expenses, the better we are prepared, the better we understand the tax law. When we do that, we absolutely are sure to make way more money and pay way less tax. Thanks, everyone. Any final words for anybody, Deanna?
Well, Tom, we do have a live question to take if you're willing. We have
Let's
a
do
minute
it.
left. Okay.
Absolutely. We have
Okay,
1 minute for one
perfect.
live question.
Hi, Pax.
I just wanted to thank you for this presentation. Good job.
Thanks, Pax. Really appreciate that. Thank you, everyone. Again, let us know if we can help. Otherwise, we'll look forward to what the next few months brings. Thanks so much, Garrett. Really appreciate everything you do. And thank you, Deanna, and the entire WealthAbility team.
Thank you, Tom. Thank you, Garrett. And thanks
Thank you.
everybody for joining us today. We appreciate your participation. Have a great day.